When we talk about trade finance, many banks' strategies have not been very coherent in terms of client-saving proposition. Some of them have focused on larger corporations, as they imply bigger margins with fewer transactions and many cross-selling opportunities, but they also come with a higher chance of default, dangerous concentration exposure, and increasingly complicated transactions. Some other banks have decided to focus on smaller companies, which results in risk diversification, pulverized exposure, and plain vanilla transactions. But they also come with very high costs for client-facing roles, strict competition from other banks, and minimal profits. A third category of banks have not yet decided which strategy they want to follow, and for that, they act between the two poles, trying to catch the best opportunities regardless of any coherent risk management strategy. Companies are often left alone to find liquidity on the market, which will then be very expensive and with an increasing number of covenants to respect. Many of those companies leave the market at once, and that results in over $1.5 trillion trade finance gap that has been a heavy burden for many companies trying to explore new business opportunities and trying to monetize their expertise, especially when doing business abroad. Consequently, many companies have historically been left out of the game. Currently, the situation has started to change, with smaller institutions, fintechs, and challenger banks focusing on being more friendly, more flexible, and highly responsive to customer demands. The very same demands that result in margin erosion in traditional banks, as they're not very customer-centered, but rather focused on internal processes. Over the years, some banks have developed a toolkit of solutions to close this gap, including a growing range of tech-based tools. However, even though the industry has started to look into the digital for better solutions and better answers for their needs, we are yet to see a full tech transformation. The $1.5 trillion trade finance gap has been consistent over the past years. However, there is some talk of this gap widening up to as much as $2.25 trillion. This represents not just a threat to many companies, but this really is a huge missed opportunity for growth that banks are often overlooking. But what are the causes that created the gap? Some of those are a heavy regulatory frameworks and requirements, the cost of KYC, and a thinning of margins, especially when serving a multitude of SMEs. Banks have a growing toolbox of solutions for customers, such as a support for government agencies, and technology should be used just as much. There is an increasing number of banks using these types of tools to mitigate credit risk. But what makes for a viable tech-based trade finance solution? There are many ways that technology can be added into bank existing architecture to improve access for current clients and to attract new ones. For example, letters of credit are fantastic candidates for digitization via collaborative effort. Collaboration between banks and tech providers would work incredibly well to supercharge these trade finance tools, making them extremely attractive for companies looking for liquidity. Finally, new technology will create growth. Big data could help us to analyze trade patterns on a broader scale, allowing us to see risks much earlier on. Artificial intelligence can also be used to create more efficient and sustainable trade finance channels. The question now should be, after a year of trade wars, barriers, and a great lockdown, can banks really avoid tech any longer?